Hey everyone, welcome back for another deep dive. This time, we're really digging into something that's been the talk of, well, pretty much everyone who even glances at the financial news. The Fed's recent rate cut.
Yeah, it's been a long time coming, hasn't it? All year, everyone's been waiting with bated breath to see what they do.
Exactly. And you know how it is. The Fed makes a move, and suddenly the entire global economy is playing this giant game of what does it mean? So today we're going beyond the headlines, really trying to unpack not just what they did, but the why behind it, the how it impacts all of us kind of stuff.
It's true, the Federal Reserve, they've got this insane balancing act, right? Trying to keep inflation from going nuts while also making sure we don't all end up jobless.
Which, let's face it, is a tougher job than it sounds. So for those of us who don't speak central bank fluently, let's break down what this rate cut actually means.
Right, because it can seem like its own language sometimes.
Totally. We're talking about the federal funds rate, which, to put it simply, is basically the interest rate banks use when they lend money to each other overnight.
Like the overnight risk-free rate that everything else kind of hinges on.
Exactly. Sounds simple enough, but here's where it gets crazy. This one rate, it influences everything else. Your mortgage, car loans, what businesses have to pay to borrow money to grow, everything. It's like the keystone holding the entire financial system together.
100%. And this recent cut, it wasn't exactly chump change either. We're talking a 50 basis point drop. Might not sound like much, but when you consider the markets are predicting a rapid race down to 2.75% within the year.
Wow, so that's
It's significant. To put it in perspective, back during the 2008 crisis, they were slashing rates at a similar pace to avoid a complete meltdown. Shows you how seriously they're taking this slowdown.
See, this is what I find fascinating, right? Like, market analysts were already predicting this rate cut way back in March. So the big question is, what took the Fed so long? What changed?
You hit the nail on the head. The Fed doesn't just throw darts at a board and decide these things. They're drowning in data. They have entire teams of, economic superheroes crunching numbers day in and day out. But even with all that brain power, their decisions really come down to two main factors: inflation and employment.
Right, the infamous dual mandate. And it always feels like those two are locked in some epic battle. Oh, cut rates to try to boost the economy. You risk inflation going haywire. Raise rates to try to tame inflation. And you risk, well, everyone losing their jobs.
It's a tough spot to be in, for sure.
It's a tough spot. And, it's interesting. Other central banks, they often only have to focus on one of those, which, don't get me wrong, it's still crazy complex, but it seems less like, trying to solve a Rubik's Cube while juggling chainsaws.
Less juggling, that's for sure. The European Central Bank, for example, they're laser focused on price stability, basically keeping inflation in check. That's their main gig.
Makes sense.
But the Fed, they've got that balancing act we were talking about, keeping inflation tame and making sure everyone who wants a job can find one. Finding that sweet spot where both of those are humming along. It's more of an art than a science sometimes, I swear.
So, okay, we've got all this data swirling around, the dual mandate looming over everyone's heads, and Jerome Powell trying to captain this massive ship through uncharted waters.
Mm-hmm.
What were the specific economic indicators that made them finally go, okay, time for a rate cut? What tipped the scales?
So over the summer, a bunch of economic data came out that was, weaker than expected, to put it mildly. Manufacturing, consumer spending, even business investment, they were all showing signs of slowing down.
Ooh, that'll definitely get your attention.
For sure. And, the Fed, they've always said they need sustained and significant evidence before they make a move.
Which makes sense. They don't want to react to every little blip in the data.
Exactly. So everyone's watching, waiting. And then comes the August jobs report. And remember, in the spring, everyone was all, the job market's amazing. Look how strong it is.
Right. Everyone was talking about it.
And then August rolls around and it's like the brakes. Not only was the job growth way lower than expected, but they also released this massive downward revision to the previous year's job numbers. Remember how we talked about those data revisions earlier?
Oh, yeah. Those things are like the plot twists in the economic data saga.
Yeah.
How big of a revision are we talking here?
It was a doozy. Basically, the Bureau of Labor Statistics was like, whoops, we accidentally overestimated job growth by over 800,000 jobs last year.
800,000. That's not a rounding error.
Not even close. It's like finding out you've been miscounting your sock drawer for a year.
And suddenly you realize you have way fewer socks than you thought.
And you need new pants because the economy just shrunk.
Okay, so the job picture wasn't as rosy as we thought, plus all those other slowing indicators.
Yeah.
It's starting to feel like a rate cut was inevitable.
Pretty much. The revised jobs data, global growth slowing down, inflation cooling off. create this perfect storm where the Fed really didn't have a choice. They had to do something, try to give the economy a little boost before things got even slower.
Right, like a bit of an economic jumpstart. But, okay, I'm going to play devil's advocate for a sec. Is it really all about those official numbers? I mean, you always hear whispers about other factors influencing the Fed's decisions.
Oh, absolutely. We'd be here all day if we tried to dissect every single thing they consider.
Right. But, like, what about the stock market? How much influence does that have, really?
That is the million-dollar question, isn't it? I mean, the Fed, they'd never admit to letting Wall Street push them around.
Of course.
But let's be real, they don't operate in a vacuum, a stock market in free fall. That spells lack of confidence in big, flashing neon lights. And that, my friend, can put a whole lot of pressure on the Fed to do something.
It's like this weird dance they do, the Fed pretending the market doesn't exist, the market hanging on their every word.
It's a whole thing. And this time, we've got the added fun of an election looming.
Oh, yeah, that's right around the corner.
The timing of this rate cut, just a few weeks before people head to the polls. Talk about walking on eggshells.
I bet. Some analysts are saying they did it to avoid looking like they're trying to influence the election. Others are saying it's a pre-election boost for the economy.
It's a mess.
So the data's pushing them, the market's watching their every move, the election's looming. But what happens next? We've talked about the what and the why of the rate cut. What about the what now?
So, in theory, when a rate cut happens, there are some typical things we see.
Hit me with the Econ 101 version.
Okay, so lower interest rates, they make it cheaper to borrow money, right?
Oh.
So theoretically, businesses, they start investing more. People are like, sweet, time for a new house, a new car. And all that spending, it's supposed to boost the economy.
Sounds like a party. Stimulate that economy?
Yeah.
But you're about to tell me it's not that simple, right?
You know me too well. You've got to remember all that other stuff we talked about. That global slowdown, trade tensions, the election that everyone's trying to either ignore or capitalize on, throws a wrench in the whole system.
Always gotta love a wrench.
And even if we just focus on how the markets usually react, well, history's taught us one thing. It's that things rarely go according to plan.
Oh, I'm all about a good plot twist.
Let's take the US dollar, for example. Usually, after a rate cut, the dollar weakens. Makes sense, right? Returns on US investments are lower. Suddenly, other currencies look a lot more attractive. Everyone's chasing those higher returns.
Right. Basic economics.
Right. But, and this is where it gets fun, when you look back at, say, the past 6 major rate cut cycles, the dollar actually went UP half the time.
Wait, seriously, so much for Econ 101. Why wouldn't it always weaken?
Because the economy is like a cat. It does whatever it wants, whenever it wants, and good luck predicting what that'll be.
Sounds about right.
But really, in a lot of those cases where the dollar strengthened even with rate cuts, other major stuff was happening at the same time that just overshadowed the Fed's moves. Like, think about the 1980s, right? The Fed was busy cutting rates left and right, but the US dollar, it was like, hold my beer, watch this. And it shot up. Why? Oil crisis.
Right.
The US was seen as a safe haven for investors, and the dollar reaped the benefits.
So it's less about the rate cuts themselves and more about the context, the timing. The Fed, they can try to set the stage, but they can't control the actors or the script, huh?
Bingo. Which brings us to, of course, the big kahuna, the word everyone's whispering about, but no one wants to say out loud.
Don't tell me.
Recession. When the Fed starts slashing rates like this, it usually means they're trying to prevent the economy from, well, contracting. Or, and this is the scarier thought, it means they're trying to pull us OUT of a downturn that's already happening.
Economic CPR.
Pretty much. But even the best economic minds, they can't always stop a recession. Looking back, a lot of those past rate cut cycles we talked about, they happen right alongside recession. So everyone gets a little twitchy when they start happening, you know.
I bet. Everyone's trying to figure out if this rate cut is like a preemptive strike against a recession, or if the Fed knows something we don't and they're just trying to brace for impact.
Right. But the dream scenario, what economists call a soft landing.
Okay, I've heard that term thrown around.
Basically, it's when the Fed manages to guide the economy to slower growth, lower inflation, you know, like tapping the brakes without sending everyone through the windshield.
A controlled slowdown instead of a crash.
You got it. Historically, though, those are about as common as, like, finding a unicorn riding a bicycle. Economies, they tend to run in cycles, and trying to time things perfectly so you avoid all the bumps along the way, it's near impossible.
But hey, we can dream, right?
Always. And there are some economists out there who think it might actually be possible this time. Inflation seems to be chilling out. The job market, though not as amazing as we thought, it's still hanging in there.
So it's not impossible.
Exactly. Fingers
Yeah.
crossed for it.
Crossed. But even if the U.S. pulls off this economic miracle, we're not out of the woods yet, right? We haven't even talked about the global impact of all this. And like they say, when the U.S. economy sneezes, the rest of the world gets pneumonia.
You're not wrong. What happens here doesn't stay here, especially when you're talking interest rates. The US dollar, it's still the world's reserve currency, which basically means when the Fed adjusts interest rates, they're sending shockwaves through the entire global financial system.
Everyone else is along for the ride, whether they like it or not.
Pretty much. Other central banks, they're watching the Fed's every move like hawks, and more often than not, they follow suit. Even if it means doing things that might not be the best for their own economies in the short term.
It's like this global game of economic follow the leader. And guess who's always it? The U.S. The trendsetter. But I'm sensing a but coming.
But, and this is where it gets interesting this time around, some central banks were like, nope, not waiting, and cut rates before the Fed could even clear its throat.
Really? Who took the lead?
We saw Switzerland, Canada, the Eurozone, even the UK. They all cut rates earlier this year.
Wow, so the Fed was almost late to its own party? What made those countries jump the gun?
Their economies were already feeling the pinch. Inflation wasn't as big of a concern for them, but growth was slowing down, and they needed to act fast. It was like, we'll ask for forgiveness later. Got to deal with this now.
A bold move. So it seems like everyone's on board with this whole rate cut thing. But wait, I'm seeing some headlines here. Japan, Russia, they're actually raising rates? What's going on there? Are they trying to start a new trend, leading a rate hike rebellion?
They're definitely the outliers in this whole rate-cutting frenzy. Japan's situation is kind of fascinating, actually. Remember how we talked about the Fed's dual mandate, that whole balancing act? Well, Japan, they've been battling the opposite problem for, forever, deflation. And now that they're finally seeing a glimmer of inflation, they're like, quick, raise rates, get it under control before it's too late.
So after years of fighting tooth and nail against deflation, they finally get a taste of inflation and they're not sure what to do. It makes you wonder if constantly doing the opposite of everyone else just becomes so ingrained in your economic policies that it's hard to break the habit, even when the situation calls for something different.
It's a really interesting thought. As for Russia, well, they've got a whole different set of challenges on their plate right now. The war in Ukraine has thrown their economy into a blender. Inflation's through the roof. Raising rates is their way of trying to get a grip on things.
Even if it means potentially hurting their economy in the long run, it's like they're stuck between a rock and a hard place, and every move has consequences. So we've got this global wave of rate cuts happening, but then a few countries going their own way. It's like watching a flock of birds suddenly scatter when a hawk flies overhead. Makes you wonder, what do they see that we don't?
Right. It really highlights just how interconnected the global economy is, but also how each country has its own unique set of circumstances to navigate.
Absolutely. And it makes me think about something we haven't really touched on yet. What are the potential long-term consequences of all these rate cuts? Because let's be real, history has a tendency to repeat itself. And when we look back, we see this pattern. Rate cuts often lead to excess liquidity.
Yes. The million-dollar phrase. And the root of so many economic mysteries.
Okay, I'm going to need a translation here. Excess liquidity in plain English.
Basically, it means there's a ton of money sloshing around in the financial system just begging to be used, and at really low interest rates, too. When central banks like the Fed start cutting rates and everyone else follows suit, it creates this flood of cheap money.
Okay, so far so good. But we all know money never stays put for long. It's always looking for a place to land, right? So where does all that cheap money go?
Well, that's the million-dollar question, isn't it? Historically, it's flowed into all sorts of assets, and sometimes, not always, but sometimes, it creates bubbles along the way. Remember the Latin American debt crisis in the 80s? The Japanese asset bubble in the late 80s, early 90s? Even the dot-com boom in the late 90s? The subprime mortgage crisis in the 2000s? All those periods, marked by easy money policies, everyone taking bigger risks because, hey, money's cheap, but it rarely ends well.
Right. Eventually the bubble bursts and everyone's left picking up the pieces. So it's like this double-edged sword. Rate cuts, they can give the economy a much-needed boost in the short term, but all that easy money floating around, it can inflate these dangerous bubbles if it's left unchecked for too long. It's like trying to water a delicate flower with a fire hose.
That's a perfect analogy. Too much of a good thing and, well...
You end up with a soggy mess.
Exactly. And that's why this latest round of rate cuts has everyone so nervous. We've got all this liquidity being pumped into the system. Will it go into productive things? Investments that create jobs, boost the economy in a sustainable way? Or are we just inflating a bunch of new bubbles, setting ourselves up for another crash down the line?
The question on everyone's mind, and as we've learned today, trying to predict the economy is about as reliable as, I don't know, trying to predict when a cat's going to finally decide to catch that laser pointer you keep waving around.
Right. There are just too many variables, too much chaos.
Exactly. But knowing what to look for, understanding the historical patterns, it definitely helps us make more informed decisions, right?
Absolutely. It's like we can't control everything, but we can at least try to anticipate the potholes and maybe, just maybe, steer around them.
Words to live by. And on that note, I think we've done our due diligence for today. We've gone from deciphering the Fed's cryptic signals to pondering the future of the global economy. All in a day's work.
All in a day's work.
But the conversation doesn't end here. For everyone listening, keep your eyes peeled, your ears open, and your minds sharp, because this story, my friends, is far from over.